My name is Kola Olofimboba, and I'll be moderating this panel. I am a partner at Fairview Capital.
Is it working?
We're a US-based private equity investment manager. We manage about $3.4 billion for institutional clients in the US. And we have recently partnered with FMO, the Dutch development finance institution, that has been invested in Africa for 40 years now, and in private equity in Africa since the early 1990s. We have focused on Africa because we see a unique and timely opportunity to participate in the entrepreneurship and business formation cycle that's being driven by the ascendance of a new consumer class on the continent. For the next session, we're going to spend some time talking about how the narrative in Africa is changing rapidly from war, disease, corruption, and the occasional safari to one of entrepreneurship, economic growth, and most important to this audience, investments. Specifically, we will touch on different asset classes to watch in 2014 for investors interested in putting capital to work in Africa. And for this discussion, we've assembled an all-star panel of investment professionals active in Africa in both private and public markets, in equities and credit, spanning the entire geography of the continent. To my left, I have Luke Rigozo from Amethyst Finance, and next to him is James Cameron from Climate Change Capital. Next to him is David Creighton from Creighton Capital, and then Joel Moser from K. Schuler. Next to him is Colin Bell from Orbach Grayson and Company, and the last panelist is Tutu Ajare from New Book Investment. I am going to open things up with the panel by asking each person in sequence to just briefly introduce their organizations and how they fit into the African investment ecosystem. And then just start by telling you what are the top areas, 1 to 3, that they feel institutional investors should consider for investment in 2014, and then why are these particularly attractive? Luke.
Thank you very much. I will begin by cheating a little bit and saying that I will say all, and I will try to explain why. If we had the right to use slides, I would have shown you that in each of the asset classes today, for the last decade, Africa has outperformed the rest of the emerging countries. It's true for foreign direct investment, which is on average 3 to 5 points, depending on the year, 3 to 5% above the rest of the emerging countries, being Asia or America. It's true for the stock market, which are the rest of the world now is as volatile as Africa in the stock market, and Africa outperformed the rest of the world by 5%, and it's true in private equity. Having said that, I would say that in 2014 and 2015, if I was an institutional investor, in my position, I'm a little bit biased by saying that, but I really mean it, I would concentrate in diversified private equity fund looking for the mid-cap market, which is the fast-growing market, low risk, growing in Africa. Thank you.
Thank you. James?
Thank you very much. My name is James Cameron. I'm founder and chairman of an enterprise called Climate Change Capital. We deploy capital into property, green buildings, clean technology, private equity, and in emission reduction projects around the world driven by a price for carbon. We're increasingly working with public money too, in the so-called payment for performance category, where funds are created by governments but managed by others according to a set of performance criteria which include environment, development, and social issues. I'm also chairman of the Overseas Development Institute, leading think tank in the UK on development matters, and I'm a shareholder in an enterprise called Agrico, which, as it sounds, is an agricultural development business with an asset in Tanzania, a large rice farm. When you put those things together, what you see is a long-standing interest in deploying capital, long-term capital if possible, for outcomes that can be measured where performance is judged according to a range of criteria, financial performance obviously, but also where one looks to see rational use of resources, genuine sustainability, and particularly where the energy, water, and food nexus lies, where you can improve productivity in each. So that's the range of interests I have in this sector, and I happen to believe that Africa is a particularly good place in its many different guises to deploy that kind of capital for those kinds of outcomes.
Thank you. David?
Thanks, Cola. David Creighton from Creighton, Montreal-based. We are a manager of assets, private sector investments, both private equity and more so private debt. We've raised $2.4 billion over the past 12 years, primarily from institutional investors, pension funds, insurance companies in North America and Europe. We've made just under 200 investments in about 55 different countries. And I guess one of the reasons why I've been invited to join you here today is we are across all the emerging markets. Africa is a very significant and probably the fastest growing region within our portfolio. And we have a very unique perspective on how Africa fits into the broader scale of investments and transactions that we're doing across the emerging markets. And to respond to your question about where I believe the greatest opportunity is, and I think I would just look at supply and demand, and the demand, if you reflect on some of the comments by Donald Kaberuka of the African Development Bank, and that there's roughly $93 billion worth of infrastructure requirements across the African continent on an annual basis going forward. His challenge and the challenge of the official donors is that they figure they can probably cover about 50% of that, and the other 50% they don't know where it's going to come from. You compound that with the retreat of the commercial banks as a result of Basel III and domestic issues that are going on, and you have an opportunity, which I see. And so that's where I'm going to leave it for now, but that's where I see the opportunity.
Thanks. Joel?
Thank you. I'm Joel Moser. I'm a partner at K. Scholler, a law firm. I'm head of the Energy and Infrastructure Group there. We represent investors, private equity funds, institutional investors, and lenders, energy and infrastructure projects around the world. I'm also a professor at Columbia University School of International and Public Affairs, where my topic is infrastructure, finance, and development. In terms of where the opportunities will be in 2014, I think that Africa will continue to be a rich source of opportunities for capital deployment, and as my panelists have already identified, particularly in the energy, water, and infrastructure space. There is a growing trend in the institutional investment community to want to invest in real assets, and real assets tend to be infrastructure assets, energy assets. I consider energy part of infrastructure, as well as core real estate assets. We recently saw the huge port in Nigeria coming to financial close, a very impressive transaction, a capital-intensive transaction. I think we will continue to see these kind of mega projects as well as opportunities, particularly in the energy space, the extractives energy space, in particular upstream exploration and production. And since we're in the New York Stock Exchange, I am not typically a listed securities guy, but I'll take a few shots at some stock tips. I would look at companies that support these kind of transactions. I would look at companies in the heavy construction space, in the oil space, particularly companies that support upstream oil exploration and development. I think there'll probably be some mergers and acquisitions activity there, and I think it would be a good place to do some deep dive research for stocks. Thank you.
Okay, thank you.
Thank you. My name is Colin Bell. I'm Director of Africa, Middle East, and South Asian Equities at Auerbach Grayson. Auerbach Grayson is a global broker focused on non-U.S. securities that partners with local banks and brokers to bring their clients local execution in the local stock markets, local research, and local access. We've been in Africa since 1992. And I guess I would approach this question from a more narrow perspective, which is the perspective of public equity markets. And if I did that, I would differentiate somewhat between East Africa and West Africa. And my preference going into 2014 would be quite a big preference for Kenya over Nigeria among the two major economic countries, And my reason would be, number one, we've kind of in the sweet spot now of the political cycle in Kenya, having recently successfully finished the national election, whereas I think in Nigeria next year we will get into the messier part of the political cycle. And the second reason I would point to is there's a clear difference, if we compare Kenya and Nigeria as a whole, between Kenya's priority of growth, which we can see in the lowering of interest rates as inflation falls, which we can see as the president's comments about his intentions over the next 5 years, versus stability in Nigeria, which we can see with single-digit inflation now, yet interest rates have not been brought down. I think it's a clear indication that Mr. Sanusi is much more interested in stability than he is in growth, and he will sacrifice growth for both currency and economic stability. And for those reasons, I think even though the public equity markets, which is 85% of what we do, even though the public equity markets have been more or less correlated with each other across the continent, I think that there's more possibility of divergence in that going forward. And for those reasons, I would very much be focused on Kenya as an investment destination.
Thank you, Colin. Tutu?
Hi, Nabuke is a multi-strategy public markets investment vehicle that goes long and short public equities. It gets involved in local currencies and fixed income trading all within the same portfolio. So we have the luxury of taking negative bets on markets and countries. And in terms of asset classes, I'd almost, to some extent, talk about countries. We do not believe that investors will generate the sort of returns that you expect in frontier markets from both South Africa and North Africa. We think that a combination of the structural challenges that they face will make it very difficult to generate returns. We're exceedingly bullish about East Africa. Like my colleague next to me, we have concerns about the combination of corruption, politics, and fundamental changes to the banking system, which will make it challenging to generate returns in Nigeria. And even though I am from Ghana, I do think that the fragility of the economy is, even with the economy which is relatively fragile, you're being paid to take the risk of having exposure in Ghana because it does have the highest interest rates in absolute terms anywhere in frontier markets. So we still think that the African continent will, on a relative basis, generate outsized returns with significantly lower correlation to the rest of the world. We think that the instability of the Middle East will lend itself towards much higher commodity prices than I think sometimes that the market expects, and we think that the China story is only over by those people who cover it from the West but not from the East, and as such I think Africa will continue to do better. So for those of you looking to invest in your portfolios, stick to the bits in between the 42nd parallel, and that's what you should be looking at.
Very good. Tutu, before we leave you, I'm just going to ask a follow-up question. So you invest in Pan-African equities and fixed income products. And so for institutional investors who might be looking at the African market, how would you suggest they participate in investing?
Well, I mean, the first way is just come and invest in my fund. That's the easiest way to do it. The good thing is that I don't think any self-respecting global fund hasn't got an Africa fund. So JP Morgan, Morgan Stanley, Templeton, everybody has one. And then you have the localized funds, which exist in continent as well, long only or fixed income. And then you have the specialist funds like ourselves, who are much more nimble and take advantage of both the good and the bad of the continent. And all of these are publicly available, all of these are publicly audited, almost all of them are regulated in jurisdictions that will give you a level of comfort that the return profile, and more importantly, the governance that surrounds these funds is fit for purpose.
And look, you provide both equity and long-term debt investment in Africa. Do you have any favorite private equity strategies that you like to work with in particular?
Thank you, Colin. Yeah, in fact, what I'm sharing with you now is not just the lesson from Amethyst, which is a recent Pan-African fund that we created 2 years ago, but also the lesson learned from when I was CEO of Poparco, where I was running a more than 2 billion portfolio debt and equity, African portfolio in 35 countries and in 140 transactions. And in fact, these lessons that I apply today in MITs, I think are sixfold as an investor in this continent. First thing I would say, you should look for diversification, and you should look diversification because it's a volatile continent. It's still a volatile continent, so you want, if you have to exit Ivory Coast in 2011 or Kenya in 2007, you have a problem. But if you have a diversified portfolio and if you can stay an additional 18 months in Kenya in 2007 and an additional 18 months in Ivory Coast in 2011, you don't have any issue. The second one is relation to time, which links with the first one. You have much better result. I could even prove that by numbers. If you are able to stay on the 6 to 8 year range, than on the 4 to 5. We had a multiple of 4 in our direct investment, staying 7 years in Africa. And the funds, we had also a small fund of fund activity in my past, had much lower than that because they were exiting too early. And multiple sometimes matter more than pure IRR.
Yep.
The third lesson is minority. There is not a big market of buyouts in Africa. Yeah, there is a few targets. Everybody's chasing them. And one of my fear is that with more players today on the continent, which is very good for the continent because there is a very big market still, if everybody chases a few big deals, you will have overpricing at entry and huge problem at exit. Because the market is not liquid enough. So the main part of the market is a market that big companies, especially in the US, cannot address. You would be surprised, and I could give you example of, for example, the first 2 deals we made. You would be surprised of the level of sophistication, even if they are small, of the companies where we invest. In fact, the mid-cap market of Africa is very similar to the mid-cap market of Europe 20 years ago. It's family-run businesses, family-run companies, well run, but they don't want to sell the majority now that they have the chance after 2 last decades to foresee a very, very strong growth. So the main good model for me is minority stakes and not buyouts, mid-sized company, and go for regional champion in regional economies. Because when you're becoming a leader in your own country in Africa, you have no other possibilities than go in your regional market. With all of that, diversification, relation to time, going in the main market, it's extremely difficult to lose money.
Okay.
And you can still tap the growth of the continent. Thank you.
And David, you have a slightly different strategy where you provide debt financing. And so just wondering, how do you work with private equity funds to do this? And how do your loans in Africa, how do they perform relative to other emerging market regions?
Well, 2 questions. An interesting one, the concept of working with private equity funds. Having managed both the private equity fund for Africa and separately having done a number of debt transactions in Africa, the one element that I see as common, regardless of whether you're thinking about infrastructure or manufacturing or what have you, is that the private equity model, I think, is faulted. And the reason for that is that if there are cost overruns, if there are reschedulings, if there's troubles that the business comes into, you quite often need more equity in order to prop the deal up. So from the debt side, we've seen a number of times, in particular when you've got cost overruns during construction phase, that a private equity fund, if they're the sponsors, they're saying, well, our fund is dry. We can't put anything from our new fund into this because then there's a conflict of interest between the two. So you, the borrower, you cough up, which is not something that we'd like to do. Separately, if we're a private equity fund, we've seen a number of situations where the guy who's the last one who can put in the last dollar is the one who tends to get the best deal of them all. Yeah. And because everybody else has run out of money, they've all thrown up their hands and walked away from the deal. So, sorry, long-winded question. Working with private equity funds, I think we just want to be careful. And then to the second part of your question, just on performance of Africa, I think similar to what Luc was saying and many others in the room, is that political risk, something that we all consider to be pretty high in Africa, is actually, from our perspective, very low. and arguably substantially. and if we're going to have a bit of a rah-rah session, I mean, we actually wrote an article for the FT, but we didn't submit it just because we felt that we were going to be opening ourselves up to too much criticism. But we were looking at political risk in the Western world, thinking about Spain with the tariffs on solar panels, the UK with their offshore wind, Ontario just down the street from us doing all kinds of shenanigans. I mean, if any of the countries that we were involved in tried to pull off some of these arrogant moves, they would get bombed back into the last century. So as a result, political risk from our perspective is low, the performance is high, and everybody's having a pretty good time.
Very, very interesting perspective. Thank you. Colin, the next question for you. So you're a global broker. You have a vast network of local partners in several African countries. How could stock exchanges in these countries, how could they facilitate more public listings on their domestic markets?
Well, I think the answers to the question are actually fairly straightforward, and probably anyone on the panel could answer, but just to give some depth to the answer, to really think about liquidity in the public markets of sub-Saharan Africa, let's just go through some quick numbers. Nigeria is the most liquid market. It trades about $20 to $25 million across the whole stock market per day. Kenya's second, probably 6 to 8 million. And then you have maybe a handful of 7 or 8 other countries that trade about 1 million or less per day. So we're talking 30, 35 per day for the whole sub-Saharan African continent, ex-South Africa. And so there is absolutely a need to deepen these markets, both in terms of number of listings and as well as liquidity. And I think the answers are pretty obvious. You know, some countries have gone through privatization programs already. Kenya started in 1995 or 6. Countries like that should continue to look for state assets that they can sell off and reorganize and whatnot. Countries who haven't started that program or have been going very slowly should accelerate that. It's the easiest way to get cash in the federal coffers, and it's the easiest way to actually make state companies more efficient. I realize it's not always in the same interest of the governments to do so, but where possible, they should do this. The second answer is a bit more subtle, but still fairly obvious. The regulators in these capital markets should do their best to not only take official steps with legislation and listing requirements, but they should do their best to not micromanage the process. And they should do their best not to push this idea of a wide base of retail, local investors, because what it often does is it drives companies, you know, legit entrepreneurial private companies to the private equity market, because it's much easier to take 2 or 3 large strategic investors, not be public, not go through all the hassles of listing requirements and annual upkeep, as opposed to having 50,000 retail investors, you know, that you don't know and will never find. So I think just, it's a basic idea, but I think less micromanagement, very clear paths to getting approvals and whatnot is the best way that you can go about that.
Thank you. To change tack a little bit, you know, talk a little bit about sustainable investing. James, I know that's an area of focus for you in agriculture, in clean energy, and in infrastructure. And just was curious, what sources of capital, private or public, do you think are needed to get these areas to scale? And what's in it for these investors?
Well, those are great questions, because I see this as being a way to finance in an instrumentally sustainability and self-reliance in Africa. If I take the particular experience of growing this enterprise in Tanzania, it in itself a large rice farm, 5,000 hectares, which we tried to develop in a sound and sustainable way, keeping the smallholders on the land, trying to use as much of the agricultural waste to generate energy. That tells you that you need to have investors that actually don't fit very well the model of private equity in Europe and North America. You need investors who are prepared to have longer holds, longer exit periods, that have, you know, frankly, a sense of commitment to development, the fact that many of the things that you would expect to be available to you to grow a business are not, and you need to perhaps find ways of cooperating with others to build capacity over time in order to get what could be very strong returns from your investment if you're prepared to endure. So I think that opens up tremendous scope for combinations of capital, public, private, philanthropic, where there are those who have an interest in the longer term and are prepared to back a vision of how things could be. I was struck by, I was at the MDG Success Gathering at the UN yesterday, and Tony Elumelu from Nigeria was making some very encouraging sounds about how long-term investment in the power sector in particular could be achieved with this combination of investment for return and investment for longer-term development. But there's another area where I think we have to think think differently about where the investment comes from for big transformations. You can see it most clearly in the telecoms sector, where telecoms and the distribution of mobile phones have completely altered the way in which other technologies can be distributed in society. So just to give you one example, it's emblematic. If you look what's happened in Kenya with very large mobile phone take-up, 80% of Kenyans have mobile phones, but only 20% have access to the grid. Well, you've seen great innovation around the use of mobile phones, for example, mobile payments, mobile banking, but now a connection has been made between that, mobile payment, and sustainable energy, with solar PV systems being sold in conjunction with the mobile phone, charges the phone, but also offers a payment system. So it may well be that we get the distribution of new technologies through infrastructure that was designed for another purpose. That the telecoms, broadband, and mobile phone penetration is actually the carrier for alternative energy systems. So this is part of what I think was very exciting about the potential to think differently about what sorts of capital could be combined to build a modern infrastructure that, as I said, ensures greater sustainability and self-reliance for Africa and doesn't necessarily replicate a model that we have established in North America and Europe.
So potentially leapfrogging technology.
Indeed, in technology, but also in the means by which we deploy the capital and the combinations of interest that we can put together in order to, frankly, win the prize of this very long-term investment.
Great. Well, Joel, you've been very patient with me going through with all the other panelists, but you're a very experienced attorney. You've done work in Africa, in energy, in infrastructure, and I'm just curious, from your vantage, when you're advising investors, what would you consider the most attractive areas for investment on the infrastructure front in Africa?
My panelists are all very wise, and much of this has been astutely articulated. First, probably invest through a fund. That's probably the smartest thing. In an emerging market, you want to have hands-on managers who know the market very well, know the risks, as David articulated earlier, understand the political risks, perhaps have a better sense that there are less risks than the market generally perceived. I think it's important, as we heard at the end of the prior session, to recognize that most institutional investors are investing the capital of others, so they have a fiduciary standard. And I completely agree with what Mr. Cameron just said about the potential for new technology in an emerging market. When you're starting with less infrastructure, it makes more sense to build something new and think through differently. But the challenge is, well, as David said, half of the, that there is the good news is that the grant funding can fund half of the infrastructure. The rest of it's going to have to be funded primarily with institutional investors who are investing to a fiduciary standard and will want to see that those are sensible investments. Unfortunately, through the existing Western established market paradigms. So what does that boil down to in terms of energy, infrastructure, and those kind of assets? In the short term, it probably means that the deals that are going to get transacted, for which there is not donor funding, are going to be those with extremely strong sovereign counterparty credits. Basically, the government is indirectly doing off-balance sheet funding, or there is an indirect government support in the nature of an actual or virtual monopoly, as in a port when there are limited license opportunities. And finally, and probably most prominently, those projects which are affiliated with extractives, resources, throughput. In the energy sector, I think it's going to be very, very, very much about upstream oil in Africa in the next year.
Thank you. Well, at this point, I would like to maybe take some questions from the audience for the panelists. Okay. In that case, oh, yes, please. Thank you, Barbara.
Contingent facility held by an institutional investor that says if the obligation is working, it's not in default, they're willing to take it out. So that enables the bank to meet its own internal capital allocations. If the asset, if they don't want to turn it over, which they will turn it over if it's performing, but if they don't, you have the institutional investor willing to back it up. You have, in effect, secured longer-term capital. I mean, there's lots of things that we can put together if we just get into a room and figure out how to do it, right? So my question is, do these things seem viable to you, and what do you see as the practical next steps in order to get there? Okay. Thank you.
I'll take a crack at that. I think what you've described is exactly what project developers, consultants, and government officials should be, and in many cases are doing, to put a complicated project together. But again, to harken back to the point that David made, that half of the infrastructure is covered generally by donor funding, and the rest, who knows. I think what will work better and get more projects done is if there is a more thoughtful application of the elements of donor funding. For example, many investors will not invest unless there's political risk insurance coverage. Political risk insurance coverage in the current market runs about 10 years. An infrastructure project usually takes at least 20 years to get paid back. So there's a gap, the back end of the political risk insurance. We should be encouraging, and there is some facilities currently, but to the extent that donor funding or donor collateral is used to provide back-end political risk insurance, you suddenly magically open up lots of long-term institutional capital that is investing on a commercial basis because it feels its political risk exposure is covered for the long term. That's just one example of the way you can make these different pieces fit together so that you can bridge the gap of projects that need to get done and the kind of risk profile that investor capital wants to take.
Luke, do you want to give that a stab, and maybe as part of that also just talk about one or two of your investments and how you have...
Oh yeah, but it's a perfect example of the changes that work on the continent. The first one is a very beautiful mid-sized bank in Kenya. Well, now when I say Kenya, I'm thinking, of course, of what happened this week in the country, but Kenya will go through that. I mean, it's a big country. And the banking sector in Kenya in the last 6 years, if you take out the first two banks, has grown on average at 30%. So when you are lucky enough as an investor to work in a country that grows at 8 to 10% in real GDP term, and in a sector that grows at 30%, you don't need to make fancy things. You don't need to return the company. You don't need to find. You need to find a good player working very well in a sector going like that, and this is what we found with Chase Bank. We invested as a minority shareholder. Just after us, 2 institutional investors joined with already a markup. It's a responsibility and DOG, the German DFI. And then, like other banks, Chase Bank will go to the stock market in a few years and will be listed. But it's a typical example what I was saying, and I agree with David. If you are lucky enough to work in such an environment, the risk is lower than investing in a leveraged buyout fund in France. That grows at 2%, and if you want to have 15% of return, you have to have 80% of leverage. I won't do that personally, but the other example in one word is you go from east to west in Ivory Coast. It's a distributor of oil and bottled gas. And it's funny because it's typically a company that has foreseen the evolution of the country and the continent. Historically, 20 years ago, it was an employee of Shell who created the company. He was selling mostly to big corporates in Ivory Coast because the market was big corporates, including state-owned corporates that were paying with 12 months or 18 months of delay. Then the son took the company, realized that the real market was retail, so went directly to retail. Sorry, sir. Went directly to retail. And then shifted to the new market that was the bottled gas market, which is growing very, very, very quickly. So now it's a purely retail company in a fast-growing with relatively sizable margin market. And they were able to survive and make benefits during the 10 years of nearly civil war of Ivory Coast. So this is also one of the paradoxes of Africa. You're dealing with companies very well run that are able to work in very volatile environments. And now, of course, that Ivory Coast is recovering, but this company will do very, very well and will also probably exit to the stock market. Well, so I'm stopping there. But examples like that, you have Andrews in Africa, so don't. And this is why I agree. I'm a little biased. I'm sorry to say that. Of course, as a fund manager, but it's true that if you want to access the continent with diversification, there is a few teams like us that can offer you that.
Great.
Thank you.
Colin, can I add something to this? Because I like this idea, Barbara, but I wouldn't want you to think that it solves another part of the problem, which is the lack of risk capital and growth capital, so that we can build businesses that could take advantage of such a facility. However, it does occur to me that we saw today very impressive presentations from pension funds in Africa of a size and with a dedication to deploy capital in their own countries and indeed in their regions that could perhaps provide such a facility. So I think that's an interesting conversation, provided you don't neglect the absolute necessity for risk capital to grow enterprises. Then maybe there's a homegrown solution in the pension funds of Africa to provide the kind of what you described as a takeout facility as well, in combination.
Well, our task was to talk about asset classes to watch in Africa, and we had a variety of practitioners in different asset classes. And as you heard, there's a broad basket of opportunity across the continent. In terms of my firm and what we do, we are particularly attracted to what's happening in private equity, particularly with the smaller funds that we think are able to focus on companies that are very consumer focused. We think that's where the biggest growth opportunity is over the next decade in Africa. But I think one key takeaway from this panel is the fact that the risk perception in Africa is very, very different from the reality. There's a risk arbitrage where investors who are astute can generate strong returns investing on the continent. And with that, I would like you to join me in thanking the panel for a very good discussion.
Doing business in Africa. You can't afford to be without Africa Investor.